We're about to watch one earnings report speedrun the AI hype cycle. Over the next 48 hours, NVIDIA will release its quarterly numbers, and with them, a single set of slides will either refuel the biggest investment boom of the decade or become the moment everyone remembers as the beginning of the end. That might sound like hype, but here's the thing. NVIDIA isn't just another tech stock reporting results. It sits at the absolute choke point of the AI economy. Every dollar flowing into artificial intelligence passes through their hands at some point, which means when they update their outlook, they're not just guiding one company's revenue, they're updating the entire story. So the question isn't whether AI will change the world someday. The question is whether the cash is still flowing faster today than it was yesterday, and whether the people writing the checks still believe hard enough to keep writing them. By the end of this video, you'll know exactly what to watch in the next 2 days to answer that question for yourself. But first, we need to strip this whole thing down to first principles, because without that foundation, you're just writing vibes and hoping someone else knows what they're doing. Let's start with the most boring sentence in finance, the one that underlies every single price move you've ever seen. Prices equal the present value of all future cash flows, adjusted for risk. That's it. When a stock goes up, it's because people now expect more cash in the future, or they're less worried about the risk of not getting it, or both. When a stock falls, the opposite happens. The whole market is just millions of people updating their mental models of future cash every second of every day. Now here's the kicker. When a company reports earnings and gives guidance, they're handing the market new information to plug into those models. If the guidance surprises people, if it's better or worse than expected, then all those models get recalculated at once. Academic research calls this post-earnings announcement drift. Prices don't just jump on the news and stop. They keep trending for days or even weeks as the new reality diffuses through the system, as analysts rewrite reports, as funds reposition, as algorithms update their signals. So if one firm's guidance can cause that kind of ripple, the natural next question is, how far does the ripple travel? Does it stay contained to that one stock, or does it wash across an entire industry, an entire narrative, maybe even multiple asset classes? To answer that, we need to figure out where NVIDIA actually sits in the stack and whether the signal it sends is just about NVIDIA or about something much bigger. Here's where it gets interesting. NVIDIA isn't competing in a normal market. They control the production of the most advanced AI accelerators on the planet, the chips that train and run the large models everyone is talking about. They've built a software moat called CUDA that every AI researcher and engineer has used for over a decade. Switching away from NVIDIA means rewriting code, retraining teams, rethinking your whole infrastructure. The cost of switching is enormous. So once you're in the NVIDIA ecosystem, you tend to stay there. On top of that, the actual manufacturing of these chips is insanely hard. They require cutting-edge packaging technology, high-bandwidth memory, and custom interconnects. There are only a handful of suppliers in the world who can do it, and they're all running at or near capacity. In supply chain terms, NVIDIA is what we call an upstream bottleneck. When a bottleneck gets tighter or looser, it doesn't just affect the bottleneck itself. It creates a bullwhip effect all the way down the chain. If NVIDIA says demand is exploding and they're sold out for the next year, that tells everyone downstream, the cloud companies, the enterprise buyers, the startups, that AI spending is real and accelerating. If NVIDIA says orders are softening or customers are pausing to digest what they've already bought, that's a system-level signal that the boom might be losing steam. So the question we're really asking isn't just what happens to NVIDIA's stock price, it's whether NVIDIA's update will confirm that the whole AI capex engine is still accelerating, or whether it's starting to slow down. And that brings us to the mechanics of how a single earnings report can move an entire market in just 2 days. When NVIDIA reports, the update doesn't just sit there as a data point. It gets amplified by the structure of modern markets in ways that can feel almost magical if you don't understand what's happening under the hood. Let's walk through it step by step. First, there's reflexivity. That's a concept from George Soros, and it just means that price moves change behavior, which then changes prices again. If NVIDIA beats and the stock soars, that move attracts momentum traders. It triggers buy signals in quantitative models. It makes headlines, it pulls in retail buyers on apps, and all that buying pushes the price even higher. The move feeds itself. Second, there's the mechanics of options and dealer hedging. Before earnings, implied volatility is sky high because nobody knows what's coming. The moment the numbers drop, that uncertainty collapses. Dealers who sold options have to adjust their hedges, often by buying or selling the stock in size. And that can create big moves in the first hour after the print third. NVIDIA is a top holding in the S&P 500, in the NASDAQ 100, in dozens of thematic ETFs. When NVIDIA moves, index funds and ETF market makers have to rebalance passive flows. The money that just tracks the index will automatically buy more if NVIDIA goes up, which pushes it up further. Fourth, there's positioning. If lots of hedge funds are long and the news is bad, they'll all try to sell at once. If they're underweight and the news is great, they'll scramble to buy, and you get a short squeeze or a chase. All of these forces can turn a single earnings surprise into a multi-day, multi-asset event. But here's the thing. The direction and the durability of that move depend entirely on whether the underlying story, the fundamental story about cash flows, is getting stronger or weaker. And that brings us to the hardest question in markets right now. Are we in a bubble? And if we are, when does it pop? Bubbles don't pop because of valuation. They pop because the incremental buyer disappears. Let me say that again. Because it's the most important sentence in this whole video. Bubbles don't pop because something is expensive. They pop because the flow of new money stops. In the late 90s, internet stocks kept going up not because the business models made sense, but because there was always another fund, another retail investor, another corporate treasury willing to buy at a higher price. The music stopped when that flow of capital dried up. In AI today, the incremental buyer isn't retail. It's not even hedge funds. It's capex, capital expenditure, from the hyperscalers and big enterprises. Google, Microsoft, Amazon, Meta, they're the ones writing billion-dollar checks to buy NVIDIA's chips and build out data centers. Their willingness to keep spending depends on four things. First, do the unit economics of AI work? Can they actually make money or save costs by deploying these models? Second, do they have the power and the infrastructure to run all this hardware? You can buy all the chips you want, but if you don't have gigawatts of electricity and cooling, they're paperweights. Third, what's the cost of capital? If interest rates are high, big capex projects get harder to justify. Fourth, are there credible alternatives? Is AMD catching up? Are companies building their own custom chips to reduce dependence on NVIDIA? If any of those four factors tighten, if the return on AI spend gets murkier, if power becomes a bottleneck, if rates stay high, if competition heats up, then the orders slow down. Backlogs shrink. Lead times compress. And suddenly the narrative shifts from "we can't get enough supply" to "maybe we ordered too much too fast." When that happens, multiples compress, and the bubble talk starts for real. We've seen this movie before in networking equipment in the early 2000s, in memory chip cycles and solar buildouts. The pattern is always the same. A supply-constrained boom driven by investment spending, followed by a moment when everyone realizes the incremental buyer has stepped back. So the question is, will NVIDIA's report show us that the incremental buyer is still there, still hungry, still writing bigger checks? Or will it show us the first signs that the buyer is getting cautious? That brings us to the scenarios. There are really only three paths this earnings report can take, and each one leads to a completely different market outcome. Let's lay them out. Scenario 1. Beat and raise with tight supply commentary. NVIDIA reports revenue and profit above expectations, guides the next quarter higher than the street thought, and says something like, "Demand is stronger than ever, we're sold out, lead times are extending, customers are fighting for allocation." If that happens, it confirms that capex is accelerating. The story isn't just intact, it's getting bigger. In that scenario, the reflexive bid kicks in hard. NVIDIA gaps up and holds through day 2. But it's not just NVIDIA. The suppliers, companies that make packaging, memory, networking gear, server chassis, they all get bought. The customers, the hyperscalers, they get bought too because it means they're going to keep spending, which means their AI products are working. The whole AI complex rallies and the narrative extends. Scenario 2. Beat but guide in line or show a deceleration in the second derivative. What does that mean? It means the numbers are still good, but the rate of improvement is slowing. Revenue grows 30% instead of 40%. Guidance is fine, but not a blowout. Maybe management says something like, "Customers are digesting their purchases," or We see strong demand, but at a more normalized pace. That's a wobble. The stock might pop on the initial beat, but by day two it fades. Valuation compresses because the growth story is shifting from hyperacceleration to growth at a reasonable rate. Leadership narrows. Maybe only the highest quality names hold up and everything else rotates. It's not a crash, but it's not a refuel either. It's a reset. Scenario 3, miss or caution. Revenue or guidance comes in light. Management mentions order digestion, power constraints slowing deployments, export restrictions biting harder, or competition from AMD or custom silicon taking share. In that scenario, you get a de-risking cascade. The backlog skepticism everyone whispered about becomes real. People start asking, did customers double order because supply was tight, and now they're canceling the excess? The multiple compresses across the whole AI complex. It's not just NVIDIA, it's the suppliers, the customers, the thematic ETFs, everything linked to the AI narrative. The story doesn't die overnight, but confidence cracks, and once confidence cracks, it's very hard to patch it back together quickly. These three scenarios aren't just different outcomes, they're different realities for the market, and each one will show up in measurable objective signals over the next 48 hours. So let's talk about exactly what to watch. Here's your dashboard, the 8 signals that will tell you in real time which scenario we're living through. First, price path. Does NVIDIA gap up on the earnings print and hold that gap through the close on day 2? If it does, that's real demand, real conviction. If it pops and then fades by the afternoon of day 2, that's supply. That's people using the pop to de-risk to sell positions they've been sitting on. It's a tell that the smart money isn't buying the story anymore. Second, breadth. Look at the equal weight semiconductor index versus NVIDIA itself. Are the smaller chip stocks rallying with NVIDIA, or is NVIDIA moving alone? Broad participation means the cycle is intact and healthy. Single name dependence means fragility. It means the market is nervous and only willing to pay up for the safest name. Third, customer confirmation. Watch the hyperscaler stocks, Microsoft, Amazon, Google, Meta. Do they rally with NVIDIA, or do they sit there or even fall? If they rally, it validates that AI capex is real and continuing. If they don't, it suggests the market is skeptical that the spending will actually flow through. Also, listen for any commentary from those companies in the days after. Do they confirm strong AI momentum, or do they stay quiet? Fourth, supplier ripple. Do the companies that sell to NVIDIA or benefit from AI buildouts, the packaging companies, the networking guys like Arista or Marvell, the server OEMs like Dell or Supermicro, do they follow through after day 1? A one-day pop that fades means the market doesn't believe it. A multi-day follow-through means the story is sticking. Fifth, volatility term structure. Implied volatility is the market's expectation of future price swings. Before earnings, front-month volatility is super high. After earnings, it should collapse because the event is over. But watch the back months. If front-month vol collapses but the longer-dated options stay elevated, it means there's still unresolved uncertainty about the future. If both collapse together, it means the market is easing its risk premium, which is bullish. Sixth, factor spillover. Momentum and quality factors. Those are the styles that tend to own high-growth tech. Do they keep getting bid after the print, or does money rotate into defensives like utilities and consumer staples? A rotation to defensives is a yellow flag. It means people are taking chips off the table. Seventh, credit check. Look at credit spreads for tech companies, especially the investment-grade spreads. If they stay stable or tighten, it means funding is open and confidence is high. If they widen, it means lenders are getting nervous about future cash flows, and that's a red flag for capex eighth, power and infrastructure plays. If the market believes the AI build-out is real and sustained, then utilities, grid equipment companies, copper miners, data center RETs, they should all strengthen in sympathy. If NVIDIA rallies but those names are flat or down, it suggests skepticism about whether the infrastructure can actually support the deployment, which means the whole story is on shakier ground than the headline numbers suggest. Those 8 signals together will give you a real-time read on which scenario is playing out. You don't need to guess. You don't need to trust talking heads. You just watch the data and let the market tell you. So here's the bottom line. This isn't a question of will the AI bubble pop or not. That's too binary and it misses the point. The real question is whether the cash flow engine is still accelerating or whether it's starting to slow down. If the engine is accelerating, if NVIDIA beats and raises and the whole complex follows through, then the story has more room to run. You stay with the picks and shovels, the companies selling the tools, but you raise your quality bar. You want the names with strong balance sheets, with real moats, with diversified customer bases. You don't want to be stuck holding the most speculative stuff if breadth starts to narrow. If the second derivative slows, if we get that wobble where the numbers are fine, but the rate of improvement is decelerating, then expect multiple normalization. That means price to earnings ratios compress and you rotate. You move toward companies that benefit from AI efficiency and inference, the software companies with clear ROI, and you move toward the infrastructure that has to get built no matter what. The power grid, the transmission lines, the real assets that don't depend on GPU unit volumes staying parabolic. If we get caution or a miss, if management sounds hesitant, or the numbers disappoint, then you're looking at a multi-week de-risking period. In that scenario, you want balance sheet strength. You want companies that generate cash today, not promises of cash in 3 years. You want real asset bottlenecks like power, copper, transmission, things that will compound regardless of whether this particular AI hype cycle keeps accelerating or takes a breather. The playbook is clear once you know which scenario you're in, but you can't know until the data drops, and you watch how the market processes it over those critical 48 hours. Here's the emotional truth underneath all the numbers and the models. One earnings print won't tell us if AI changes the world. We already know it will. The models work, the technology is real, the long-term story is intact. What this print will tell us is who actually gets paid first and whether the people writing the checks today still believe hard enough to keep writing them tomorrow. In the next 48 hours, forget the hype, forget the headlines, forget the tweets. Just watch the cash flow conveyor belt. Watch whether it's speeding up or slowing down. If it keeps moving faster, the story lives, and you stay in the game with discipline and quality. If it stutters even for a moment, the bubble talk writes itself, and you adjust accordingly. Markets don't care about the future in some abstract sense. They care about the trajectory of expectations right now, and that trajectory is about to get updated in real time. So keep your eyes open, trust the signals, and remember that in the end, the market always pays the people who watch the fundamentals and the flows, while everyone else is busy arguing about vibes. If you found this useful, hit subscribe, drop a comment with what you're watching most closely, and let's see together which path we're on when the numbers drop. Thanks for watching, and I'll see you in the next one.